Hopefully you can hear me. I'm not quite sure why you can't hear Anna. It's very, very stormy outside, so it could be something to do with that. But yeah, Anna's switched off her microphone, so you won't be hearing her anymore, Izzy. And you should be able to hear me. If someone could just say, yes, that's fine, that would be great. Perfect. Thank you very much again, Chris. Thank you. Just move the chat box out of the way. I'm going to assume you can hear me okay. Right, what I was going to focus on, let's just have a look at the three sisters, the three main US markets. There we go. And really the only one that's moving, the YM here, this is the YM, the NQ, and the ES on the daily. The YM for the Dow, the NQ for NASDAQ, and the ES for S&P 500. And as you can see here, or maybe you can't see, you can if I do that. Probably can't even see there. It is the tiniest sliver. It's a razor. It's not even a razor blade. It is an eyelid of price action. Literally an eyelash of price action there. So small you can hardly see it. So that's where the YM's been all day. The NASDAQ on it has been going its own sweet way higher, and it's been dragging the ES with it a little bit, but not terribly dramatically. So it's a bit of a crawl for, well, crawl. The YM is not even a crawl; it's a standstill. The ES is a crawl, and the NQ is at least, or has at least moved. It's now in pretty strong congestion, as indeed are all the others. And really, just to reinforce it, that's where the YM's been doing since 2:30. Cash markets here, up and down, very strong resistance, ceiling of resistance here with the accumulation distribution indicator. As I'm sure many of you know, this is like Popeye and the spinach. The more spinach he eats, the stronger his muscles become. And so it is with the accumulation distribution indicator. The more this level is tested and retested and holds, then the stronger it becomes. This has been tested 12 times and held, so it's a very, very strong ceiling of resistance. And you can see it coming into play here. We've got the VPOC here itself. We've got a ton of volume sitting around this region, which is what we expect to see. But in terms of a breakaway through that, then it becomes obviously a very strong platform of support once we get a close above it into this relatively light volume and on up into much, much lighter volume above. If the NQ and the ES can drag the YM higher, we will see. But it's a very strong platform in place on the 5-minute there on the YM. This is what the NQ has been doing. A lot of volatility opened, what we always get. Big trap move to the upside, reversal back down, another trap up into congestion. Still trading around this first candle, didn't really go anywhere. Had another one here as well, but really not going anywhere. Then we've had the rally. Volume's okay. It's not dramatic. The reversal here is not dramatic particularly, and we're just trading around this level. We've been sat for a while now, and the volume point of control, as you'll see on the other charts, is also sitting there. This is the ES, pretty similar sort of price action. Not particularly great for trading, certainly not on anything very slow at any rate. What I really wanted to focus on are just the non-time-based charts. If we go to, let's go to tick first. I've got these here. There we go. So we're on the tick charts for, this is on the NQ. I've avoided the other two. But the reason that we've been around here is because with the volume point of control is pretty much in evidence on all these charts. See where it is on this one. It's just below. So it's really a case of waiting and being patient, and all the signals are that this market is struggling at the moment. But that said, the VIX is falling gently. It's not. Let's just pull this over. Pop this up. This is what the VIX is doing. This is on 3 and on 5 and on 20 minutes. So that's on 1 minute, 3 minute, 5 minute and 20 minute. So there is some, there's some downwards momentum in terms of the VIX. Trend monitor's red, as you can see, exactly the same principle. The trend monitor's applied to the volatility index and works in the same way. Obviously, what we want to see for equities rising is the trend monitor red and the VIX falling, which is what we're seeing at the moment. and have seen for a little while, although not that strongly. We're still trading in the 20s. We're up at 21.5, so we've not moved that much. Now we're starting to see a little bit of a move away from this volume point of control. Top line is the equivalent time frame. So I've got the 1 minute, the 2 minute, and the 3 minute. And down at the bottom here, I've got the equivalent tick charts for those particular time frames. And these values that I've got here, this 377 tick, the 610 tick, and the 1597, although this, as you can see down here, has changed to 987, and I'll change that in a moment. They are drawn from the Tickspeedometer here. And what the Tickspeedometer was developed for was really two reasons. First of all, to deliver the tick settings. And you might ask the question, well, what is the advantage of trading on a tick chart? What is it about a tick chart, and what is it about a Renko chart that what are the benefits? What are the advantages? What are the disadvantages? The big advantages of both is that they offer the same thing. In other words, they are non-time dependent. So they will therefore, they take away the issue of time, and therefore on a tick chart, on this particular tick chart, on 377 tick, then the metric to close off the candle is when 377 ticks have gone through the channel. It has no relationship to time. So that can be seconds, it could be nanoseconds in a very fast moving market. These are very sluggish at the moment. So, these are taking a few seconds to build these particular charts. But when the market is fast moving at the start of a session, or when you get news, or you get some sort of release, or whatever it may be, then these charts actually move. And what you're seeing is momentum. Now, someone said to me, well, that's awfully interesting, but you see momentum on a time chart. It's true to a point, but what you see on a tick chart, and the same is true of a Renko chart, is really, if you think about it, it's the disassembly of the candle. If you think of a 5-minute candle, for example, what happens in a 5-minute candle? Well, all that happens is the price action goes up and down and up and down and up and down and up and down, and then it closes off after 5 minutes. To actually see inside that candle, that is what a tick chart and a Renko chart do. They disassemble the single candle, if you like, into a more descriptive form of the chart, because there are simply more of them. And in doing that, you get a completely different kind of chart, and you get a different perspective. And in also doing that, you see momentum. So within a 5-minute or a 10-minute candle or a 15-minute candle, you're only going to get one candle. On a tick chart, you're going to get a multiple of candles. And that's really the principle. And it's the same is true on a Renko, which I've also got in another workspace. I'll move to that in a moment. But the Renko is exactly the same. It's not dependent on time. It's only dependent on either the brick size that you set, or with the Renko Optimizer that we developed, the optimal setting that you've got it set to. And that again is the metric. So it's completely independent of time. And that's predominantly why a lot of traders migrate ultimately to trading either non-time-based charts in isolation, or non-time-based charts as a blend with time-based charts. Because on a non-time-based charts, you see the momentum within each candle. And on a time-based chart, each candle may oscillate, the price action may go up and down within that particular candle, but it's not going to build a mini chart, if you like. So what you see is mini charts all the time, which build obviously into a big chart. So you'd see a different perspective of price action, and you see that raw momentum, because as the market speeds up and slows down, that is reflected on a tick chart, and it's not reflected on a time chart. It's as simple as that, because it cannot be, because on a time chart, there's nothing else that governs the formation of candles other than time itself. So how can it reflect momentum? It can't, whereas a tick chart and a Renko chart do. Because if the market speeds up, and rest assured it speeds up and slows down throughout the trading session, then that is what is going to be revealed on these non-time based charts. And that is the key point as to why they are so advantageous, and why a lot of traders, particularly intraday scalping traders, will migrate ultimately towards using non-time based charts. As I say, either as a blend with time-based charts, which is absolutely fine, which is essentially what we have here. We have the time charts above, we've got the Renko, the tick charts below. But there is an issue with tick charts and an issue with Renko charts, and the issue is exactly the same. The question is, what do you set them to? And I've done a lot of videos on TradeStation which are going up on the quantum trading channel in preparation for the launch of TradeStation, and they really explain this principle in detail, because it's all about this issue of non-time and really bringing it all together into the understanding of why these charts are so advantageous. You can see over here, and this is why we developed the Tickspeedometer, because the issue with both of them is, well, what do you set them to? With a Renko, what is the brick size for pound yen? What is the brick size for cable? What is the brick size for euro dollar? And what is the brick size for an index future? And does it stay the same? And of course, the answer to both those is no, it doesn't stay the same. It varies throughout the session. And you'll see that on the Tickspeedometer. These numbers here, which are delivering the tick speed, will vary the whole time. Obviously, on the actual, they're changing literally second by second. You can see it here as 282, 284, 286. You know, up and down it goes. The number here, it's a mathematical fix, if you like. Its only relationship to Fibonacci is that it was the way we came up with a mathematical way of giving a number that was relatively close to the actual, which didn't mean changing the chart literally second by second. And as I always recommend, when you're trading on Globex only, I tend to use the actual because it doesn't change that often, or less frequently at any rate. And when you're trading on cash and Globex, then I'll use this number here, which doesn't change so frequently. It means you don't have to change the chart setting so often. You can see these are reasonably stable, 233, 610, 987. Relatively stable, and this is it's a relatively quiet market, but we are actually trading Globex and cash simultaneously, which is fine. So to go back to the issue, that is the issue you have if you're trading tick charts. First of all, what do you set them to? And secondly, do they differ from market to market? And I suppose the third thing is, do they differ throughout the day? And the answer is yes to all of those. So you have to know what to set them through. That's what we developed the Tickspeedometer for. Yes, every single market has a different characteristic. If I change this over to the ES, those numbers would change dramatically. They would be much higher because the ES is a much more heavily traded index than the NQ. And equally, if I change the YM, they'd be lower. So the span of tick activity or the tick settings for the three indices, the three primary US indices, during a particular session, if I line the three up and had the Tickspeedometer running on all three, which I've actually done on TradeStation, if you can have a look at it on the quantum channel, you'll see the huge variation. It goes from a few hundred on one to several thousand on another. So the issue of setting a tick chart is not guesswork. It's not phone a friend. It's not, oh, you know, have a look in a forum or someone said this and someone said that. You know, it's a bit more scientific than that. And the same is true of Renko charts. What are you going to set them to? Is it 2 pips, 3 pips? Is it the same for all pairs? No, they all have a characteristic. Every single instrument you trade has a personality. You can think of these as people almost. They have their own personality. They have their own imprint. And that imprint is revealed in some respect in terms of their tick profiles and their Renko profiles. Because if you're not trading in harmony with them, then you know you're just guessing. I mean, if you're going to trade the NQ and say, well, I'm going to use a 100 tick or 50 tick or 39 or whatever it is, well, it's just a guess. At least this way, you have a way of knowing what it is to a particular time frame and the particular tick setting to set it to. And this, as I say, the same principle is true on Renko. Not a lot going on there at the moment. Same will be true over on Renko. There we go. Pop that out of the way. I've got the NQ here. I've got, these are pretty quick. I've got 15 second, 30 second and a minute. So, you know, a lot quicker than over on the tick time frame, which was 1, 2, 3, I think. But again, you can see we've got the volume point of control down here in evidence, and this is all being reflected on the Renko, but the Renko is exactly the same. And what I've got set here is I've got the optimal settings. So in terms of the time frame, I've got the 15 second, which I've selected. So we'll just select it again, just see if it's changed at all. Okay, that's coming up as 8. It says select an 8 brick size. What does that actually mean? What that means is that 8 is the smallest number. The Renko always defaults to the smallest price movement size for that particular contract. And for NQ, it's a tick. So in other words, what this is telling you is that we've got 8 ticks. In other words, there's 4 ticks in a point. So this is a 2-point brick. So if we move that out there, you can see this. Each of these bricks is therefore 2 points. And I can assure you that 2 points is worth having on the NQ, even if you're trading one contract. But if you're trading multiples, it's certainly worth having. So that's on the 15 seconds. So that is delivering it the optimal setting. It's telling you this is the optimal setting for the NQ at this point in the trading session. Now, you know, if we ran this through to 9 o'clock, close of the market, or just before, this would have varied. This will probably be slower. It will have slowed down. And this is the other point. Traders don't seem to appreciate that markets speed up and slow down throughout the whole period of the session. It's not a case that one size fits all. This is not a sort of set and forget type approach where you say, okay, that's it, I'm done. I'm going to put 2 points, that's it. I'm done for the rest of the day. I'm going to put it on at 2 points and run it for 8 hours. It doesn't work like that. The market speeds up and slows down the whole time. It has momentum at the start of the session. It'll settle into a routine during the main part of the session that may be punctuated with increases and speeding up and slowing down. As you can see here, you know, it speeds up, it jerks forward, and then it slows down a bit. It jerks forward, it slows down a bit. That's what this market is about. All markets are the same. Let's just see what this one is. This is on 30 seconds, so just click on that one. We'll click on 30 seconds. Just see what that delivers. Okay, that's gone to 12. So we'll click on that. They're all coming up. Nice, easy maths today. So that's basically divide that by 4, and you've got 3. So this is delivering 3 points. And then we'll go over onto this one, which is on a minute. Just click that one. There we go. So that's delivering 18. There we go. I'll leave you to do the maths on that. So that is why we developed both of these sorts of indicators to actually deliver the optimal setting for non-time-based approached trading. And because the issue is the same, what do you set them to? Do you guess, or do you have some more scientific way of arriving at what those brick sizes should be? Obviously, within both indicators, you know, you can set them to whatever you wish. Within the Renko, you can set it to 2 points, 1 point, 3 points, whatever you fancy. But this is actually telling you, and using them in a multiple approach like this, in exactly the same way as you do time charts and tick charts as well. I mean, you physically see the momentum coming into the market. You see these start to build quickly. You see the same in tick charts. You start to see, it's like, I always explain it, you know, when the market opens, if you've got these running at a market open, these bricks and these tick charts will form like a Gatling gun. There'll be bullets fired at the wall from a machine gun. That's how quick they come out. And that's really the demonstrable aspect of trading using non-time-based charts. It's that aspect. Yes, you see volatility on a time-based chart for sure, but you don't see that deconstructed into a recognizable and tradable pattern of either bricks or candles. Just going to pause there for a moment. I haven't gone away. I'm just checking in on seeing what's happening on the volume at the bottom. And like everything in trading, you know, what you see on a 15-second chart is the same on any other chart. We had a volatility trigger, we had a ton of volume come in, we expect to see congestion, we get congestion. We had another volatility trigger, we expect to see congestion or reversal. What have we got? Reversal. You know, a bearish engulfing candle, overlaying this one, fine. Now we're down to the volume point of control. You know, we're going to sit around here for a bit now. Let's kind of look at the slightly slower time frame of 30 seconds. What have we got there? We had initial weakness on that candle, decent volume. Then we had the volatility candle. That's what we expect to see. Okay, now we're looking for a reversal. We've got one, or a congestion. but we've got reversal in this case. Maybe a little bit too early to say it's a reversal. It could be congestion. We could be moving within this candle. But once we break below it, then we can pretty safely assume that we've got some sort of reversal going on. Next question is, where are we going back to? Well, the volume point of control is down here. There's not much in the way of price support to actually support this reversal lower. The first one that comes into play is down here at 250. If you were going to trade this short, the question you've got to ask yourself is, is that enough for me? And thereafter, I'm running into heavy volume on the volume point of control and then down into the volume point of control itself. So in terms of a short on this market, is there enough in there for me? And that really answers the question what Anna was saying in about the risk reward issue. That is how we judge it. We look at the chart. Is there enough reward in there for the amount of risk I'm going to put on the table? If so, all well and good. If there isn't, I don't take the trade. It's as simple as that. And the price acts as support as does volume, and the heavier the volume, then the more important it is, because if price is going to drive through this region, it's got to have decent volume behind it. In other words, volume under here to push through this stuff that is going to act as volume resistance. It's like a dense area that is going to hinder progress of that particular move. So if you took this opportunity, and you were looking at it and think, right, okay, yeah, 8 points is enough for me, that's fine, I'd be quite happy with that. Here's where it's probably going to find a bit of congestion. It's going to pause a bit, and certainly below that, we've got lots of 26 reasons as to why it's going to congest here. We've got the volume point of control, we've got lots of volume, we've got some price support coming in here, we've got more down here, another layer, we've got a little cluster here, that's pretty strong. It's moving around here as the volume's building around this region. This is where it's testing, prodding away. It's a decent move, and all triggered through the prism of the volatility indicator. This is such a powerful indicator. I cannot tell you how powerful this indicator is. It will keep you out of more trouble than anything you care to mention, both financially and emotionally. And there we go on the Renkos. There we are, nice move developing. So, this is what the Renko does. It delivers not only momentum, but it also delivers very smooth price action. The trend dots are on here. They've rolled. They've gone over onto the top. They will always change first. The trend dots will always change color first. Then we're into red trend dots, pushing down, pushing down. Then we get the trend monitor kicking in to confirm. It's what you expect to see. It's why we always strongly, strongly urge you to buy both. Not because we want to sell two indicators, it's just they work so perfectly together. They are the perfect combination. This signals first, this kicks in and confirms. It's just, it's a powerful combination. It's a match made in heaven. Exactly the same here, rolled over onto the top, trend dots pressing down. Nice transition on the trend monitor. Didn't even bother going into a transitionary color here. It's such a strong trend lower. And of course, over onto our slowest one, we haven't yet seen the reversal come through here. We've got the trend dot changing color. Now we're starting to see it. And that's the principle. It's the principle of multiple time frames. It ripples through. It starts in your fastest. Whatever your fastest is, this is 15 second, as is the Renko aligned to it. It could be 5 minute, could be half an hour, could be anything. Doesn't matter. The principle is starts in the fastest, into the mid chart and out to the slowest, and that's it. You look at it down here from a VPA perspective. Excuse me for a moment. I'm just going to switch off. I haven't gone away. I've got a frog in my throat. Then you're down onto looking at it from a VPA perspective. Rising volume, falling price, rising volume, falling price. You've got nice price waterfall going on. Let's have a look at the, let's just move that out of the way. Let's have a look at the 1 minute. Here we are, 1 minute. What are we seeing? Really a similar sort of thing that Anna was showing on her chart with regard to, weakness, the appearance of weakness. This is the appearance of weakness. High volume, big wick. Then we see confirmation of weakness. Market's really trying to struggle to get up here. More volume, higher volume, hasn't gone anywhere. Then we get the next candle. You could overlay those two and you would almost come up with an upthrust, pretty much. That's what you'd be left with. Then we get further weakness and then bang, off we go. And then we've gone surprisingly, straight through the volume point of control, which is unusual. We've gone out the other side. We've gone into low volume. We expect the market to move through there pretty rapidly. Why? Because there's nothing in the way of volume to support the price. All we've got down here is some minor price support, price-based support, which is kind of coming into play a little bit, but even that's been taken out. Nice rising volume. So you've got a perfect price waterfall. This is what you expect to see. It's not perfect in the sense of price spreads, because a perfect one, if I drew a perfect one, it would have widening spreads. So the first candle might be that width, the second one might be that width, and then the third one's a real big one, and then on down you go. It's exactly like a waterfall. It's that arching effect of price action. You want to see it that sort of shape and rising volume, because it takes effort to go up as the same as it does to go down. And there we are. Nice little move, not particularly stressful, all signaled live, nice and easy, and confirmed with the indicators, which really, really help to just give you the confidence. The reason we developed the trend monitor and the trend dots is to give you the confidence in the hardest thing to do in trading, which is to stay in. Getting in, anyone can do. Getting out, anyone can do. Staying in, not many people can do. That's the hardest part. If you can learn how to stay in and take as much out of the market as you can once you're in a trend, and not be scared out of it by the market oscillations, that is when your trading account will start to move forward. And unless you can master that, that's where I would say 99.9% of problems lie with trading, because it is the fundamental building block of the whole premise of the financial trading world, which is that you take small losses, and quite a few of them, but the winners that you take are bigger, and less of them, but they outweigh all the little losses. And that's a very simple principle, it's a very simple concept to grasp, but to actually action it is immensely difficult. We can all take small losses with comfort. You know, we all learn how to lose. That's part of moving forward. But actually staying in a trend, once it's underway, once you've got some decent profit in there, then that is the hardest thing to do. And it's why we developed the trend monitor and the trend dots. And you can see it here in action. You know, you have this little pullback, and your first reaction is emotional stress. You know, pull the plug, get out. Oh my gosh, you know, I don't want to lose my X number of pips or my X number of dollars or whatever it is, and it starts to pull back against me, and no, I don't want, no, and you close out. That's the way we are made. It's a human reaction. It's not your fault. It's not my fault. It's not Anna's fault. It's just the way we are. That's the way we evolved. When we've got something, we want to hang on to it. We don't want to give it back, which is a natural reaction. And that's why we develop the indicators, because it is the hardest thing to do in trading. It doesn't matter if you're trading Renko charts or tick charts or time charts or any other market. It makes no difference. The principle is the same. And using multiple time frames will help partially in that. Using indicators like the trend monitor and the trend dots will help. Using non-time based charts will also help, because it'll reveal the inner momentum of the market and when it's speeding up and slowing down. So when it's slowing down, as it does on the tick chart, then you know you get the red comes in. Where are we? There we are. What you see happening on the tick speedometer is, and this is another facet of it, is that it actually changes color to show you, to give you this traffic light system to tell you that the market is lacking participation. So expect congestion. Don't expect wild price action, expect a congestion phase to build, because that is what the indicator is telling you through the prism of participation and volume. The same is true here. We're seeing it now reflected on, what are we on here? I can't remember now. 2 minute, okay, we're on 1, 2, 3. So it's coming in on the 2, it's coming in on the 3. And what you'll also see is you'll see a drop off in the tick activity. Now this may have speeded up because I wasn't on the chart. It probably did, because you had the green here coming in. That was reflecting this price waterfall. It was basically saying to you, look, we've got some nice price action going on here. We've got orange, green, orange, green. That's great. We want to be trading in orange and green. Green is the punctuation of volume. Orange is what we normally expect to be running at. When we've got these chunks of red, that's what we don't want to see. It means, there's not much going on. There's lack of participation. There's no momentum in the market. To see momentum, you want to get primarily green. If it was green all the time, it would be wonderful. But predominantly, you're going to see orange and green. So at the moment, what we're seeing is we've got red, red, red. So we've got a full set of red. You can imagine it like the starting grid of the Formula One, right? All the lights are red, absolutely nothing happening. And then they'll suddenly go to green, bang, off we go again. Same principle. Just change this one over because this is too high. Let's change that to 987 tick. There we are, and we're running at the right speeds now. 377, 610, and 987 tick. So we're in congestion. Okay, we're coming out a little bit here, flip-flopping around, maybe getting a bit of red coming in again. You can see it here. It's not great. Low participation at the moment. So we've had a nice little run down. And the other way of dealing with holding a trend and maximizing what you can take from the trend is to scale out. The scaling out, sorry, Don. Scaling out comes at a price because the principle of scaling out is premised on something that hasn't actually happened yet. In other words, you are premising it on the fact that you think you're right, which is fine. So when you scale out, you're going in with a bunch of contracts and then you basically take some off the table once that profit has been established and you just leave some to run. That's one approach, but as I say, it is premised on the fact that you are basing it on an assumption. Scaling in, on the other hand, is premised on a fact that has happened. In other words, it's based on the fact that you've made some profit already, and therefore you're proposing to build a position in the market based on that positive result. It's a very different philosophy, a philosophical approach to trading. And you have to find the one that you're comfortable with. Some traders are more comfortable with scaling in, or some traders are more comfortable with scaling out. And again, it doesn't matter whether it's a big contract size or whether you're dealing with micro lots, mini lots, whatever it may be, the smallest contract size possible. You can still apply the same principles, exactly the same principles apply. And if you're scaling out in this situation, you're sitting there and you might at this point be saying, okay, we're in congestion. I've got some decent profit. I'm going to take a bunch of it off the table. So I've got 5 contracts I went in with. I'm going to take 4 off and leave 1 to run, or I'll take 3 off and leave 2 to run. However comfortable you feel with what you're seeing on the chart right now. If you think this is setting up for a full-blown reversal, then maybe you take 4 off and leave 1. But at least when leaving 1, you've still got to play in the market. You're not square the market. You're not out of the market. I'll just see if this does break away or whether it's going to sit here for a while. Yeah. We'll just give it a minute or so. If we break through 36, then if we break through that level there, then you can see the trend monitor is still red. The volume to the upside, this volume here is very low, it's falling away, so it looks pretty positive to me. It's going to carry on down, which it seems to be. Because this rally here, look at the volume. You've got volume, volume, volume. It's all falling away. So you've got market trying to go up on falling volume. Not going to happen. And in addition to that, we've got nice low volume node here. So we're coming down to that. So we've got more to come. And this is what I mean. You close out, you maybe closed out one of these reversals, and now you're sitting there thinking, why did I do that? Well, I've lost this lot. Now I'm losing this lot. Looks as though it's going deepest. Okay, thanks, darling. Looks as though it's going deeper still. And up onto the 3 minutes. What did the 3 minute tell us? Pretty much the same story, trying to rally, falling volume, not looking terribly strong. And of course, in addition to that, on the right-hand side, I've got the VIX, which is now kicking up. So it's giving me a signal. Just going to clear my throat for a moment. Hold on. So there we go. This is what the VIX is doing. Just pull that over just before we wrap up. There we go. That's why we're seeing this reversal, because we've got the VIX. The VIX is reversed. We've got the trend monitors change blue. Works exactly the same way. And same principles. Transitional blue. Nothing on 20. You wouldn't expect it's too far out in terms of time horizon. But that's what we're seeing right now. And that's why we're seeing what we're seeing in terms of equities. And if you don't have the VIX up, then go and find one. You can find it on investing.com. Go and get it on TradingView. Works brilliantly. And, you know, it's just delivering all the time. There we go. Nice and straightforward. Nice straightforward trading. And you can see the tick speeders now. We're hopping around here a little bit. You know, there's an injection of pace there. A bit more pace came in on that one. Bit more pace. We've gone back into our shell again. So there we go. Right, I'm going to wrap up. We've been going over time. Let me just go to where we are. Right, let's just go to Anna's site. This is where you find all the bits and pieces. This is Anna's site, annacooling.com. You'll find the analysis there. You'll find copies of the videos there as well. All the books are up on Amazon. They're either in Kindle or paperback, so you'll find them all there, and all the links to other various sites as well. In terms of the indicators, this is where they are, quantumtrading.com. You'll find them for MT45, NinjaTrader 7.8, and also TradingView and TradeStation. Yes, it is coming. We have put another load of work on our development team, so you know, it's going to take a little bit longer, but we are working flat out. I can assure you, videos, support pages, all sorts of things going on. It is coming along. Rest assured. I know it's taken a long time, but then these things always do. Thereafter, after TradeStation, we've got two versions of TradeStation. We've got TradeStation Global, which is TradeStation version 9.5 with interactive brokers. So if you have an IB account, then it's a very powerful combination. You've got deep discount brokerage working with a powerful platform, a charting platform. It's a brilliant combination. The other is TradeStation Securities, TradeStation 10. You've got radar screen and all that good stuff. It's just a fantastic platform. It's very exciting. Can't wait to get it launched. After we've done that, we're going to drop back onto TradingView, and we're going to fill in the blanks there where we had indicators that we couldn't port across. We are going to port them across, and if you're a TradingView full package customer, as was, you will actually get those as part and parcel of the upgrade, so no need to worry. In terms of the education program, this is where you'll find it, Quantum Trading Education. It's called the Complete Forex Trading Program because that's exactly what it is. It has everything you need to know to become a confident and successful Forex trader, from the psychology to the fundamental, relational, technical, and mechanics of trading. 200 hours plus of videos, plus you get all the indicators as well. The complete package. It is the complete package of everything, and it's just, we've had such amazing feedback on it, and we have a whole bunch of students on the program, and they love it. And of course, it's also backed up by the VPA Traders Room, where we host every day. We're in there answering questions, and of course, your fellow students there also as well. That's it. There's the VPA Traders over there on the left-hand side. That's it. That's us done. Thank you so much for coming along today. I hope you've enjoyed it. Hope you found it useful. Maybe learned something you didn't know before. And we will see you next week at 7:45 UK time for the London Forex session. Enjoy the rest of the trading day. Enjoy the rest of the trading week. Have a great weekend. Stay safe and well, and we will see you back here next week at the same time, 5:15 on Thursday. And if not, we'll see you 7:45 on Tuesday. So thanks a lot. Thanks very much for coming along today. Hope you've enjoyed it. See you soon, and bye for now.